What about if we did a covered call on a stock that was about to go ex-dividend? And remember, you can't be paid for a dividend unless you own that stock on the ex-dividend date. So will we come out ahead by doing a covered call instead of selling a put option on a stock that's about to go ex-dividend? It just so happens that we sold a put option today in Kimberly-Clark, ticker symbol KMB. Kimberly-Clark actually goes ex-dividend before our put option expires. Would it have been better for us to do a covered call option instead of selling a put option? Here you see the trade we did. We sold one contract of the Kimberly-Clark September 17th 135 put options and were paid $1.90 per share. Kimberly-Clark actually went up in price a little bit after we did this trade. So you can see here, now the market is closed, the bid for that same put option is $1.70 per share and the ask is $1.85 per share. So let's go in the middle and say that we could get about $1.77 per share for selling this put option. Notice if we had done a covered call option, would have been paid right at $2.30 per share for that same 135 strike price call option. If we did that covered call, that 135 strike option will be $1.35 in the money. So in order to figure out how much time value we'd have received for selling this call option, we need to take out that $1.35 from the $2.30 that the option is currently trading for. As you can see, at least 95 cents per share in time value premium that the covered call option would pay us if we did that trade. Shouldn't the time value premium of each side, the put versus the call, be the same or pretty close to it if it's the same strike price? The answer is typically yes. I've alluded to that in several of my videos. If you have the options in the money and want to see how much time value is left in that option, you can quickly look at the corresponding put or call option at the same strike price that's out of the money, and it'll give you a quick estimate of how much time value is left in that option. So why is it off by 82 cents? The answer is that Kimberly-Clark is about to go ex-dividend, as you can see here on September 9th. And that dividend will be $1.14 per share. The reason why the time value is different in these two options is because when Kimberly-Clark goes ex-dividend on September 9th, the price of that stock should drop, at least initially, by the amount of that dividend. Now it will move around up and down throughout the day, but initially the stock should drop by that dividend amount on the ex-dividend date. The reason that the company is giving away that money to its investors. So it will literally be worth $1.14 per share less than it was the day before. And you and I, the people that own the stock, will be worth $1.14 more because we received that dividend. That expected drop in price is priced into the put option when a stock is about to go ex-dividend.